Good morning, everybody, and thanks for joining us for our Budget 2026 webinar this morning. I appreciate you all taking the time out. So most of you know me, my name is Jonathan Sheahan, and I'm going to take up another 29 minutes of your time just running through yesterday's budget. First point here in terms of running order, we'll aim to be wrapped up by 11:30. I'll probably speak until about 11:25. I think we'll have a few minutes for Q&A at the end. On Zoom, there is a little Q&A button, so if you put questions to me, I'll be able to see them throughout the webinar, and I'll try to either answer them while they're asked, or if not, I'll try to get to them at the end. And if there's more questions than we have time for, I'll try to come back to people separately. This webinar is being recorded, so we'll send you the recording afterwards, and if there's any particular people you want to send it on to, that's absolutely fine. I will also send on the slides afterwards in PDF format. And just to point that a lot of what was discussed yesterday in the budget and what we'll discuss today is about tax. But just to note, Compass Private Wealth doesn't advise on tax. We're financial planning, wealth management. I am personally tax qualified, but by no means do we give tax advice. That's for your own tax advisor. So just a quick word on our webinar series. Last week we had an investment markets update. This is a quarterly market update that we have every 3 months, usually the first week after quarter end. So we had that last week. Today we're talking about the budget. Next Wednesday, same time next week, we're going to run a pensions webinar. So that's going through all things retirement funding, different types of pensions. So it might be a bit, I suppose, detailed. But for anybody who's interested in getting a better handle on their own pension or their clients' pensions or whatever it might be, that would be one to tune in for. And then finally, we're going to have a cash flow planning session on Thursday, the 23rd, with myself and my colleague, Amy Horgan. And we're going to discuss the financial planning software that we use and just think big picture outside of just investments or just pensions or the budget, overall cash flow planning. Before we jump into the budget, I just want to give you a quick 2-3 minutes on the economic and market update. So this slide has come from our Q3 market update, Q3 being the period ending 30th of September. So where we are at the moment at this point in time is that a lot of the stock markets, equity markets, are close to all-time highs at the moment. We've had very strong runs, in particular in technology companies. You're aware of the Magnificent Seven. So a lot of tech companies in the US have driven earnings and growth and market capitalization and equity market returns quite significantly. But I guess one key point that we had in the last few months and actually year to date in 2025 is the weakness of the dollar. So by the end of September, the dollar had weakened to about 118 versus the euro. So like the dollar's weakened by about 12 or 13% year to date. So that's a big headwind for Irish investors because we're euro-based, and when we see the dollar weakening, that's negative. So, there's a lot happening with tariffs, a lot of noise at the moment. So overall, the economic picture is quite uncertain, but markets have shrunk them off, and certainly equity markets, and a lot of the markets are trading at all-time highs, albeit for euro investors, we don't benefit fully from that because of the weakening dollar. 3 key stats. Irish unemployment at around 4.7% in the budget. Yesterday they mentioned about 4.5% is where we're currently looking to be. Inflation is Eurozone about 2.2%, Irish inflation roughly 2%. That's the perfect place, and this is all relevant for the budget because these are the types of indicators that Chambers and Donoghue will look at in terms of the challenges from Trump and tariffs and what's happening with inflation in Ireland, interest rates and things like that. And interest rates, I guess, a target interest rate of 2% and target inflation of 2% is the ideal scenario. And that's kind of where we want to get to is you want interest, you want inflation, you don't want more than 3 or 4 or 5% inflation, but you don't want stagflation, you don't want things to be going at zero either or negative. So you want about a 2% inflation and you want interest rates to be about the 2%. So that 2.2%, that's kind of the target we're looking for. Markets, okay, so Euro stocks. So this year has been very, very positive for certain markets. Okay, Europe has done particularly well, but remember, Europe is still a fairly small cog in the wheel. We're only just mentioning the Euro stocks and the DAX Germany here just to show you how strong Europe has been. But ultimately, this one here, the MSCI World, that's the bottom line. As at the 30th of September, that was up about just under 4% year to date. That's the barometer for most Irish equity investors. Because if you want to have a globally diversified portfolio, you want to look at the MSCI World Index. We have the currencies up here, and bond yields have kind of stabilized so far this year. Bonds haven't done too much year to date, but they are now an investable asset class again. What are we looking out for? Obviously, what's next? Like we kind of a lot of the tariffs now is baked in, but what's next for the US policy? The first point, Europe has been strong. We do have challenges. Obviously, we've seen in France this week in different areas politically. Can the European strength generally continue? And what is going to happen with AI? AI is a very, very big factor. So obviously we had a full webinar on markets last week. I won't take too much more time now to talk about markets, but this is just hopefully a nice clear snapshot view as to where we are with markets. Okay, so budget, key points. I've just tried to put 10 key points here, and then we have other sections further on in the presentation to go through. So the overall package was 9.4 billion. To most people, that's just a number, but 1.3 billion, sorry, of that was tax measures. And the government have said they're running a surplus budget of about 5 billion at the moment. So, at a high level, these numbers are quite expected as such, okay? A key point in this budget, which was different to the last couple of budgets, is that the income rate, tax bands, and credits are completely unchanged. They did change in the last couple of budgets, but they didn't change for 2026, and I have a slide on that next. This was huge, okay, and it's a very, very important factor for business owners that the entrepreneurial relief of 10%, so up until now, on the first 1 million of company sales, there's a 10% special capital gains tax rate on the first million, and above that, 33%. But they've changed that 1 million has moved up to 1.5 million, which is really good. And as well as that, if someone has previously benefited from the 1 million, they have another 500 grand of scope. So this is, very encouraging, I suppose, for business owners and entrepreneurs. The minimum wage has increased again this year, which I was chatting to somebody running a coffee shop yesterday, and they were saying, on the one hand, the 9% VAT rate would be positive, but obviously it's countered by certain things like the minimum wage going up. And it's not just the people on the minimum wage go up, but obviously that ship, it rises everybody at the same time. So people on 16 or 17 or 18 euros are increasing as well. So that's a bit of a challenge, certainly for small businesses. But obviously there's positives to it as well. VAT rate for hospitality, food and beverage and things like that, down from 13.5% to 9%. That was really big, I suppose, news item from yesterday, but that's not going to kick in until halfway through next year. We've had a lot of moving parts on stamp duty and property, and for a lot of our clients here in Compass Private Wealth, that's obviously a big factor in terms of any properties they wish to purchase either personally or as investment properties or whatever it might be, and that's unchanged. So the stamp duty on commercial is currently 7.5%, and then there's 1% and 2% kind of for residential, depending on the value. So stamp duty unchanged. Now, the caveat here, by the way, is that the budget was just 2 minutes of standing up talking with a bit of Q&A afterwards, but the devil will be in the detail in the finance bill, which will be published this month, and then the Finance Act, which comes into law. So there's a few moving parts. So these are obviously not definitive because they're always subject to change. The VAT and sale of new apartments, the reason why that's important is because the government are really prioritising property and they want more apartments to be built. So this is a very welcome measure, I'm sure, for certain developers to ultimately increase the supply. Capital acquisition tax thresholds have stayed the same. And the reason why I have this staying the same is because they did change last year quite significantly. And I'll mention this later on in the presentation also. The social welfare and state pension have all increased. And that's important because even though we're no longer running at the same inflation rate that we had a few years ago, we still do have a couple of percent of inflation. And when I say inflation, people here might say, oh God, but things are still way more expensive than they were before. But inflation really is measured on a kind of an annual basis. So when we say inflation is at 2.2% or 2%, that's on a 12-month basis, say from August of last year to August of this year, September last year to September this year. So whenever talk about inflation, just remember that different people have different inflation rates depending on what products or services they consume. But generally speaking, we might say inflation is benign at 2%, but actually, since inflation kicked off a few years ago, prices have risen by about 30% in some cases if you factor in all of the annual increases from when they first kicked off, kind of around the end of COVID until now. So if anybody wants any good data on that, just ping myself and one of the team afterwards, because the CSO has some great infographics and stats on it. We can share the links. Yeah. Employee small gift exemption. So that's anybody who is an employer who wants to, gift anything onto their staff. Again, this is subject to change in the Finance Bill or Finance Act, but there was no real mention of any change yesterday. Okay, so there are 10. There's a lot discussed in the budget yesterday, but there are 10 of the main factors. Okay, so income tax is something that everybody is subject to on income, obviously, so it's probably the most relevant section here for anybody. So very importantly, the tax credit, okay, so the tax credit, which was increased to 2,000 last year, and that might be a personal tax credit, it might be 4,000 euros for a couple, there's a PAYE tax credit of 2,000, they all stay the same. And 2,000 is a good number, but it's just that we have been used to small increases, but that's been paused, okay, to 2,000. Then, as you know, in Ireland, the first 44,000 at the moment is taxed at 20% for an individual, and then after that is 40%. So the standard rate band of up to 44,000 is the same, and marginal tax above 44,000 is still the same at 40%. So no change in tax credits or the tax bands as such, okay? Small, subtle changes here, okay? So USC, Universal Social Charge, the ceiling for a 2% band is slightly increased, but the PRSI rate for Class A has gone from 4.1 to 4.2, and it's indicated to go up again, not definitive, again in October 2026. So this is a very small change. So if you're watching prime time, for example, last night, they actually talked about in some cases people are slightly less off, people typical family earning X or whatever it might be, and that's because things like the PRSI is slightly increased, and there's other subtle changes as well. But it's certainly not a giveaway budget from a personal tax perspective. So as I said, the 44,000 is the same. A couple with one person working, again, this is all really good. If you want to contact me or any of the team afterwards, we'll direct you to the revenue website. A very good page going through an individual, the standard rate cut off, an individual with a spouse not working, both spouses working, that type of thing. So those cut-offs are the same. So from a payroll perspective, there'll be very little changes, for ARF distributions or for PAYE earned income from December 2025 to January 2026. And I just put this in because a lot of our clients are kind of in retirement or approaching retirement. It's just a very important point. A lot of people forget that if you're above 66, you don't pay PRSI. And at around 4%, that's a fairly significant saving. Even on 100,000 income, that's 4,000. The only exception to that, is where we get quite technical, is that it is possible now to defer the state pension from 66, say, up to 70. For certain reasons, that may make sense for a very small part of the population. But the downside to that is you still pay PRSI. So, but for 99.9% of people, you stop paying PRSI at 66, which is a big saving. And that's, looks like that's set in stone. My very first employer, Deloitte, I think there might be one or two Deloitte people on this webinar today. They have an excellent tax calculator, which when we send the slides, this link would bring you to it. But what I like about it is that you're able to put it as an advisor, like we have other financial planning tools and stuff that we use, but enables you just to put in amounts in each brackets and just to give the net income amount. So a lot of people say to me, oh gosh, like in Ireland, we pay over 50% tax, and yeah, that's true at the marginal higher rate if you're earning more than 100,000, whatever it might be. But in a very simple scenario, if you have a couple earning 100 grand each, I think in this particular case, I think I put in to the calculator 80,000 in earned income each and 20,000 each in passive, like investment income, and it just comes out at 200 grand total. But of 200,000, you're actually netting about 129,000. So that's usually a far higher proportion of net income that you're getting than one would expect. And here, just on the bottom, it shows a slight difference between 2026 and 2025. So, in fairness, they had it updated quite quickly straight after the budget last night. So that's just a useful tool to play around with. Okay, so all clients here know that I'm obsessed with pensions. I just think they're the best vehicle for investing, for getting tax relief, for funding your retirement. So with pensions, okay, so there's no change to the standard fund threshold. It's currently 2 million, but it's going up by 200,000 every year from 2026 to 2029. And it was funny because they announced last year in the budget, the finance bill, that the threshold was going up from 2 million, but they announced it in 2024, but it wasn't coming in until 2026. So even though it was mentioned last year, it's still worth mentioning again today that from next year, the target pension goes up. So when we sit down with clients and you're doing funding calculations, it's just good to see that the threshold is increasing all the time. The lump sum of pension stays the same. You can get 25% out in the lump sum. Of that 25%, the first 200k is tax free, and the next at 300,000. At 20%. Because the balance above 500,000 of a lump sum is taxed at 40%, it usually makes sense to cap the lump sum at 500,000. There's really, you'll hear more about this in the webinar next week on pensions, but it's very tax advantageous to contribute to a pension both from a company and as an individual. So there's no change to the very positive benefits on personal tax relief and corporate tax relief at the moment. A big thing here for companies is that auto enrollment is definitely happening, and it's definitely started in January. And so business owners just need to be mindful of this. From my understanding is that payroll operators have already done a great job, and they're getting prepared so that it should be quite seamless in January to start deducting 1.5% from the employer and the employee and top it up to the state. But auto enrollment is here. Every worker between 23 and 60 who's earning more than 20 grand a year is going to be auto enrolled into a pension from January, if they're not already in a pension. So that's pre-retirement, okay? And post-retirement is just a pension vehicle you have after you retire the pension. Not if you retire from work. You can retire your pension and continue to work. But post-retirement pension, the state pension is increasing, or has increased by €10 to just under 300 a week. So ultimately, it's about just over 15 grand a year in gross income. So it's a very good staple for couples who are both turning 66, assuming they've full 40 years service, full contributory state pension, 30 grand a year gross is very, very valid and very, very important. If you recall, a few years ago, there was talk of the state pension going to 67 or 68. No mention of that. Looks like that's absolutely solid. ARFs is the post-retirement pension that your pre-retirement pension pops into after you take 25% out. That no change to that. 4% if you're over 60, 5% over 70, and 6% if the value is more than 2 million. That's the amount you're forced to take out every year. It calls an imputed distribution. And again, investment growth within pensions continue to be tax-free. Okay, so that's very, very important. because pensions are extremely tax efficient as a vehicle. Capital taxes. So there are three types of group thresholds. There's Group A, which is parent to child. That stays the same at 400,000. That went from 335 to 400,000 last year. It's still at 400,000. Group B, nephew, niece, or grandchild, 40,000. And stranger, anybody who's not Group A or Group B at 20,000. Okay, so these are very important from a succession planning, from a financial planning perspective. And the cash rate for gift tax and inheritance tax remains at 33%. But this is extremely high. We encourage all our clients and any professional advisors here on the call to encourage their clients that ultimately, on death, after the thresholds, the government will take 1/3 of your assets in tax. And there's lots of ways to mitigate that in your lifetime. Small gift exemption, 3,000 per person per year. That's really, really important. Very effective financial planning strategy, and lots of other areas which you can talk to us about. Probably the most important thing from yesterday is that the taxation of funds has gone from 41% to 38%. And this is really, really positive, and it just means that 3% less tax on growth is actually a very big number when you consider, say, devising an investment strategy and trying to mitigate tax as much as possible. So frankly, for us in Compass, it makes it more compelling to go down a particular type of investment structure than it had been. We were already very much in favour of the 41% tax because, or sorry, of the tax regime rather than the rate, because if you go into a fund, you can have all your growth and income roll up within the fund, then it's only taxed once on the way out. That 41 coming out to 38, very, very advantageous. Deposit interest was irrelevant 3 or 4 years ago when we didn't have deposit rates. Now banks are back paying deposit rates. That's still taxed at 33%, which is lower than exit tax rates, but still it's a non-investment asset, so 33% is where that's at. CGT is still at 33%. I was chatting to one of my colleagues in the office yesterday about this, the 38 versus the 33. If you're invested in CGT assets at 33%, that's only on the gain. But any CGT assets, for example, property that you have, by default produce an income, and the income tax rate for a lot of people will be over 50% on the marginal tax on said income. So if you weigh up, is 38% higher than 33%? Yes, on gain. But remember, the 38% is on growth and income rolled up, whereas the 33% is just gain, and then that produces income tax liability potentially over 50%. So the CGT route is probably more expensive, certainly for marginal rate taxpayers. That's what I mentioned here, income from CGT liable assets at over 50%. And there's no change mentioned so far on the filing requirements for investment taxes. So they did say that there'd be a bit of a regime put in place. I don't expect an SSAA type thing, but there might be some new product developed next year. I know anybody here who's lived in the UK are very familiar with ISAs, where you set up your own little personal investment ISA account. There's tax advantages for that. I think something's going to happen next year, but it's kind of been kicked down, the can's been kicked down the road a bit. There's a very good update we got from Aviva actually this morning from Jim Power, the economist. He was on prime time actually last night, and I took this slide, and it's just, I thought it was a very relevant slide because it just shows property prices, okay, nationally in Dublin and outside Dublin over the last over 20 years. And a couple of points that we're still enjoying price increases, and the property prices have increased by about 7.5% in the last 12 months. But importantly here, average property prices are now 20% higher than the peak of July 2007. So if any of you would like a copy of Jim's report, just contact any of us in Compass and we'll just forward it on. No issue with that. This is one of a number of really good graphics and stats. So just to finish on financial planning principles, and if any more questions come in, 3 phases to retirement: planning for retirement, transitioning to retirement, and being in retirement. So much what was discussed in the budget yesterday is relevant for retirement. Key principles: maximize contributions, be flexible in your retirement age, have a cash flow, a capital plan. And here, 8 pillars of holistic wealth management. This is all relevant from budget yesterday. It's relevant for every decision anybody makes from a financial planning perspective. You may be retired in some cases, but if you're not, you're going to reach a point where you have to plan for retirement. All that means is plan to pivot off earned income into passive income. Having your assets allocated appropriately to your risk is important. No matter what you do, you don't want to be overpaying fees and you don't want to be overpaying unnecessary taxes. That's something we think is really important. Risk management, how important is this? We've all seen mistakes made with leveraged property, bank shares, people putting too many eggs in too many baskets. The biggest thing Compass Private Wealth would be accused of is being too boring. Frankly, in our advice, solid, steady as she goes, avoid unnecessary risks, really important. Everybody should be financially updated in terms of education. Everyone should have a good handle on what's happened with the budget yesterday, what's happened with taxes, what's happening with all these various factors. When you have your asset allocation decided, how your portfolio is populated, investment selection is very important. What's the most appropriate provider? That's something we prioritize. Cash flow planning, you'll hear all about that in the webinar in 2 weeks' time. That's very relevant as well, purely because if you're running cash flow surplus, by default, you're adding to your capital every year. If you're running a cash flow deficit, which it's fine to do that in retirement, you're somewhat depleting your capital every year. So finding the correlation between cash flow planning and capital is really important. And succession planning, especially for anybody with children or grandkids who's kind of approaching the twilight years, having a bit of a robust plan in place for succession planning is really, really important. That's it. That's our presentation. These are just other slides which we show you in the presentation which we send out. I have time for one question. It's in relation to PRSA contributions. Yes, okay, so very briefly, up until 2024, a company for 2023 and 2024 was able to take cash in their company balance sheet, and as long as they had a salary for that company, were able to make a large, limitless employer contribution into a PRSA. The government changed that in 2026 so that that contribution was no longer limitless, but it was restricted to 100% of salary. There's been no change and no mention of any change to that. I don't foresee anything in the Finance Bill or the Finance Act, to be honest. But overall, it does get quite complex when you're looking at contributing to a pension because from a company's perspective, there's a couple of different structures and options there. So do reach out to us, any business owners, if you want any particular advice in that area. That's it, guys. We're on time to finish. Thank you very much, everybody, for joining us. And do reach out if you want a copy of any of the reports or the links that I mentioned. Take care.